Just test that. Okay, perfect. Okay, so I think we can get started. Hello, everyone. Thanks a lot to all of you for joining us for this morning session, which will cover topics around data transparency, impact funds, and emerging markets. So we are very happy to be presenting here at Building Bridges Week this year, and grateful for the opportunity to be able to showcase the results of the research we've been undertaking over the past summer months. My name is Ramkumar Narayanan, and I'm the head of Market Intelligence and Investment Solutions at Tameo. And one of the core products around market intelligence at Tameo is the industry report on impact funds that we produce every year. So we are very happy with my colleague Anne to be able to present you the key takeaways of the 2022 edition, which, by the way, is going to release publicly in a couple of weeks. So I'll get started with the program for this morning for the next 90 minutes. So I'll start with a brief introduction about Tameo as the company, and then give you high-level takeaways on the fund universe that we are looking at Tameo, before giving the floor to my colleague Anne Estopé, who will do a deep dive into the impact fund sample that we managed to collect and analyze for this year's study. Then this will be followed by an expert panel discussion with four fantastic speakers. So I'm very happy and thankful to welcome Sarah Jerry, Vice President of the Genderlands Initiative for Switzerland, Marc Nabil Abdulmasih, CEO of Inex Capital, Christian Regnault-Kelly, sorry if I mispronounced that, Head of Investor Solutions at Incofin, and JP Dalman, who will be moderating the session. So he's the CEO of ILA and Partners. So we'll have an interesting discussion, I think, about the key takeaways of the report, but of course the state of impact fund in emerging markets. And we'll leave a bit of time at the end for Q&A session with the audience. So I'll start very quickly on introducing Tameo. So for those of you who don't know our company, we are a young firm that was created back in December 2020. And we are a Swiss-based impact investing specialist, as you can see here on the slide, guiding investment funds, managers, and investors through the entire impact investing journey. So how do we do that? We provide independent support services. We have 4 of them, and I'll briefly explain what they are. But the overall aim for Tameo is to really, through those services, to facilitate impactful capital flows towards developing countries, but also in domestic markets, promote accountability, promote data transparency, and really try to put forward evidence-based decision-making tools for investors and fund managers. So we've built solutions, independent solutions, around 4 verticals that you can see here: market intelligence, impact solutions, investment solutions, and fund solutions. A bit more details on each of these activities. So under market intelligence, of course, this encompasses all the work that Anne and I have been doing on collecting data and producing impact fund reports about funds investing in emerging markets. But not only that, so Tameo is about to set up a data-driven digital platform called Tameo Analytics, which will in fact house and centralize all the market intelligence output tools that Tameo has been developing over the past couple of years. And you'll have access to key information and data on private market impact investing strategies. So Tameo Analytics today is in the beta development phase, and we are about to go live very soon. So we'll keep you posted at the end of the presentation on how you can access this tool going forward. The second vertical, impact solutions. So here we work with our clients to provide them fund level and company level impact reports, impact reporting tools. But not only that, we also provide support and advice with anything related to impact management and measurement processes. So this, for example, can be linked to helping them set up an impact framework at company or fund level, or selecting specific impact performance KPIs for their measurement processes. Another sub-service under the impact solution that I want to point out is that Tameo today acts as an independent verification agent for investors and fund managers' impact management processes when they are aligning with leading industry standards. So, for example, we are verifiers of the alignment of investors to the operating principles for impact management. So that those are one of the standards we look at, and we are positioning ourselves as certifiers of true processes and impact. On the investment solutions, so the third vertical, just to precise here, Tameo is not doing investments per se, so we don't do any debt or any equity, but we again provide the tools to support more capital allocation in the industry. And how do we do that? We do deal and portfolio valuations, so at the asset level for fund managers and investors, and also pre-investment due diligence on companies positioned in the impact space. And finally, our fourth vertical called Fund Solution. So here this relates really to a recent mandate that Tameo was awarded by the Swiss government to act as the business services manager for the Swiss Investment Fund for Emerging Markets, so SIFEM. So here our role will entail governance and administrative support, portfolio delegation oversight, as you can see here, risk management, compliance, and communications. So that was a quick overview about Tameo as a company, and happy to, of course, have a chat with you after the presentation if you want to know more. So let's dive now into the core topic of the session today, the Impact Fund Report 2022. So before giving the floor to Anne, I'll just give you a quick background on what is the study about and the market that we look at Tameo, because within impact investing, you can do a lot of things, see at a lot of different products. So just to clarify and set the stage for Anne to be able to present the numbers. So what we do every year through this study is to really bring more transparency and data about private market impact investing strategies that flow through funds, and funds that only focus on emerging and frontier market. So as you can see, it's a very specific niche within a global approach of doing impact investing. And this is what we believe at Tameo really brings added value, because this type of work and data that you'll see, that Anne will present, is today not available elsewhere. And it's really valuable because in private markets, information is scarce, and we are really trying to centralize and provide benchmarks and data around, what the products are doing this actively in the market. This year, we are doing the third edition, releasing, as I mentioned, in a couple of weeks, and we have integrated two special focus topics this year. So we are looking at investments from funds into fintechs, as well as investments from funds and fund managers' approaches with gender lens investment thesis. So both of these elements will present a bit of results around that as well. Quick notes and a quick thanks to our report sponsors, because I just want to emphasize that without the support of our key sponsors, this type of research initiative wouldn't be possible today. So this year the report has the lead sponsorship from the Center for Financial Inclusion at Action. The Luxembourg government also as sponsored through the Ministry of Foreign and European Affairs, and Symbiotics, who's been supportive of this initiative for the past couple of years. And of course, a big thanks to also our 10 co-sponsors that you can see here, including the Gender Lens Initiative for Switzerland, with whom we've managed to develop key indicators at fund manager and fund level around gender lens. So before, again, giving the floor to Anne, I'll just set the context at what we look at, just to really frame what we are going to talk about. Today, impact investing, sizing the market is a very challenging exercise, as you can imagine. There's a lot of things going on. It's very diverse, the industry. So today, I think the industry agrees that there are a couple of numbers that are universally agreed as part of the market sizing. One of those is the Jeans number that was released a couple of years ago of US dollar 715 billion, which looks at measured impact from a global perspective, so investments into developed markets, developing countries, listed, private. So it's really a bulk of approaches, but we feel it's a good basis to start. And at Tameo, when we do our market sizing exercise, since we look at a niche within those 715 billion, we are today very comfortable to estimate the size of the market we look at. So how do we do that? So we start with the 715 billion and we trickle down. So we first remove all the investments that are in listed markets, so listed debt, listed equity. So we only focus on private assets, so private debt, private equity instruments. Then we also filter out all the investments that flow to developed countries, so Western Europe, North America, for example, and only focus on flows to emerging and frontier market. And out of those, we look at the activities of fund managers and basically strategies that run to private debt, private equity, and mixed funds. And that's the last bubble that you can see here in orange, and that's the size that we estimate today of our specific niche market, $77 billion US. A bit more emphasis on this market. So here you have a table which breaks down in terms of number of funds and the cumulative size of the market at 77 billion. So here you can see that we've identified over 670 private asset impact funds, and they are collectively run by nearly 350 investment managers, so 345 to be precise. And the estimated market size, again, 77 billion, and you have contrasting, approaches. So you can see that in terms of number of funds, multi-sector approaches, so funds not only focusing on a specific impact team, but really having a diversified portfolio across many impact sector, dominates in terms of number and in fact mass as well. 205 funds, 26 billion US dollars. This is followed by microfinance funds, which have historically been, one of the first vehicles to facilitate financial inclusion. So 123 funds today in the market, nearly 20 billion in size cumulatively. And then you have climate and energy funds, SME development funds, nearly at 115, 116 funds. And then you have the rest composing the 671. So again, what I want to point out here is a very diverse fund universe. That's really, even within those different types of sectorial approach, there's a lot of different business models. You can do private debt, you can do private equity, you can mix, you can do infrastructure. So there's a lot going on, and it's very challenging to really capture the whole market, obviously. So it's a working process. We've started when a couple of years ago we had less than 500 funds in our database. Today it's nearly 700, and it keeps growing. So we are really following the market to see, what's happening. And if you see every 2 days there's like new fund creation, new fund closing. So it's a very active, space. Just a final word on Switzerland, since we are at Building Bridges, and I think Switzerland plays really a key role in terms of being the headquarters of investment managers running those funds. And so 15% of the 77 billion today is managed by companies based in Switzerland. So this is a leading country. It's not the first. So the first is the US. So they manage 1/4 of this mass. And the top 3 countries together, I think they manage more than 50% of at least what we observe in the market. But yeah, so again, Switzerland is really a leading, jurisdiction for this. And I think it fuels also the discussions around Building Bridges on the importance of our, country as a hub for impact investing. So that's it for me. I'm very happy to give the floor to my colleague Anne Stoppe, who really, again, did a great job in running the survey over the summer months. It's been a record year for Tameo. We've, as Gilles mentioned, we've managed to gather data from nearly 200 impact funds. So it, again, keeps growing. We started at 120, 150, 170, and this year we are at 198. So it's really a great achievement, and happy to give the floor to Anne. Thank you.
Thanks, Ram, and hi, everyone. Thank you very much again for joining us for this session this morning. So my name is Anne, and I'm very glad to walk you through the main findings of the report today. So on this slide, you can see the key highlights of the report, and also the structure of the presentation that we'll go through. So starting on our sample, we see that it stands at 29 billion today, and it covers nearly 40% of the entire market, as Ram just presented. This represents 94 investment managers and 198 funds. In terms of assets under management, so we see that in our sample, Switzerland accounts for a third so companies headquartered in Switzerland account for a third of AUMs, and Luxembourg is still the prime location to register a fund. When we look at the source of capital, we see that 2/3 are coming from private institutional investors, and that growth resumed to pre-COVID level in 2021 to 17%. We will then look at aggregated portfolio breakdowns, and you see here that private debt remains the main instruments for PIFE. We also have a 50% exposure to microfinance in our sample. And then we'll look at impact measurement practices and metrics. And we see here that PIFE really have a clear intentionality to channel capital towards lower income countries and also underserved populations, such as rural and clients and women. So a bit more about our sample. So as I say, it stands at 29 billion for the 2022 edition of the PIFE survey. So it has increased since the first edition in 2019, which was at 22 billion. And we cover 90% of the microfinance fund industry. In the table next to the graph, you can see that we actually categorize funds according to sectorial peer groups and also assets classes peer groups. So for example, to categorize a fund in climate and energy, it needs to have 50% or more of its assets invested in that category. And we also look at the bulk of investments into either debt or equity to classify them. So we also have several multi-sector funds which don't have a main, I would say, main strategy, but are investing across different sectors, and also mixed fund investing across both debt and equity. So microfinance is the main sector in terms of number of funds, followed by climate and energy, food and agriculture, and SME development. We also see that the bulk of our sample is in fixed income, which is quite different from what we see in the market, where there are more private equity funds. But yeah, so that's what we see in our sample. Just mentioning, this is different from these peer groups are a bit different from the aggregated portfolio, outstanding portfolio that we will also deep dive into. And yeah, I think it's important to just keep in mind this difference. This year, we also identified the funds that report to the SFDR, and this is about half of our sample. And we also asked investment manager if they were integrating gender lens consideration in their investment approach, and if they were screening and investing in fintech and embedded finance strategies. So now in terms of location, so we see that our sample is tilted toward European companies, as there's a small, okay. So our sample is tilted toward European companies, and about a third of AUMs are managed by companies that are headquartered in Switzerland. So this is a bit different from what Ram just mentioned before for the overall universe. But we see that 4 countries, Switzerland, Germany, the Netherlands, and the United States account for more than 75% of AUMs. And in terms of concentration level, the top 10 investment manager represents 64% of total AUMs at the end of 2021, which is signaling a relatively concentrated market on its upper segment. As I said, Luxembourg remains the prime location to register a fund for European companies, and it's followed by the United States for North America and Mauritius for Africa and Asian companies. So all the data that I will present here and that we collected is at the end of 2021. I think that's just important to mention. And here we look at the average fund size, which stands at 150 million. And we see quite a lot of difference across our peer groups by sectors and strategy, with microfinance and fixed income funds being typically larger. And we see that education and health, as well as housing, water, and communities are the smallest funds. Then I think it's interesting to point out that equity funds are also lower than typically lower than the average. And this reflects their business model, as they need less diversification than fixed income funds and typically have lower amounts of investees in their portfolio. In terms of types of funding, we see that a third of funds in our sample are leveraged. So either they are raising both debt and equity through notes and shares. And this is a ratio that is quite stable since the first edition of the survey. And for these leverage funds, we see that in 2021, the debt-to-equity ratio was above 1, meaning that they finance a majority of their assets through debt. Now, regardless of the financing model they select, in the graph below, you can see the investor composition for all funds and across our peer groups. So about 2/3 of funds came from private institutional investors. And we see some differences for climate and energy, as well as education and health, which typically fund most of their fundings from public funders. So in 2021, growth resumed to pre-COVID levels at 17% on average, and which is above what investment manager expected at 12%. So growth improved compared to 2020 across all asset strategies, and we see an impressive growth for equity funds at 80%, but would like to nuance this result as we are starting from a lower AUM basis for this sample. Also in 2022, investment manager foresee still a positive growth, although a bit lower than 2021 at 6%. So now diving into outstanding portfolio exposure at the end of 2021. And again, I would like to stress that this is different from our peer groups by sector and asset strategy. So we see that private debt remains the main instrument used by PIFE, and especially senior debt. So both private debt and equity increased since the first edition of the survey. And we see here as well that the exposure to listed instruments is very low, which is in line with our focus on private assets. In terms of exposure by impact sector, we still have a 50% exposure to microfinance in our sample, although this is decreasing over the years as we are including more funds in different impact sectors into the sample. SME development is the second most attended sector at 24%, And this is in line with the financial inclusion narrative that we see. And then I would just like to point out that climate and energy in red was at 7% in 2020. And this year, actually, we split it into two categories, renewable energy and energy efficiency, as well as climate and biodiversity. So overall, these two categories account for 9% of the total. And in terms of geography, Latin America and the Caribbean, as well as Eastern Europe and Central Asia, account for more than 50% of the portfolio across all funds, with many differences across strategies and sectors. So microfinance and fixed income funds are, again, in line, are driving these results. But then, interestingly, we see that South Asia, for example, in dark blue, is very important for SME development funds and for equity funds. And also Sub-Saharan Africa, which represents 11% of the total, is actually much more important for education and health and food and agriculture funds. And finally, in terms of invested type, we see that most of the portfolio allocation in emerging and frontier markets flows through financial institution. And this is quite true across all sectors and strategy, just an exception for food and agriculture, which mainly invest into non-financial SMEs. We see also that project finance is mainly used by climate and energy funds. And this year we also had fintech and embedded finance categories in our sample, in our classification, as we have a special topic on this. So before moving on to the impact metrics, you can see here the median net returns for 2021. And so we segment the analysis between unleveraged and leveraged funds, for which we present the coupon returns. And so I think it's interesting to see that across all strategy and share class, net returns improved compared to 2020, and in some cases are even higher than 2019 levels, such as equity funds, for example. Market sentiment for 2022 is overall positive, with about half of the funds expecting an increase, 1/4 expecting a stable year, and the rest expecting a slight or moderate decrease. No funds are expecting a high decrease for 2022. So now in terms of impact, we see that SDGs are emerging as the main framework to measure funds' impact. And also many funds are using internally developed tools. There are four main SDGs targeted, which are Goal 1, no poverty, Goal 5, gender equality, Goal 8, decent work and economic growth, and Goal 10, reduced inequalities. So Goal 5 being one of the most targeted SDG, we have a special topic this year on gender lens investing approach, which Ram will have the opportunity to discuss in more detail during the Swiss Sustainable Finance session later today. But we still wanted to present two indicators that we find interesting at both the investment manager level and the fund level. So we asked investment manager for the share of women across their organization and across different teams. And maybe it's worth noting that the bulk of our sample is into small companies that typically have between 0 to 50 FTEs. So looking at the graph, if you look at the two bottom categories, we see that overall gender parity is good, with nearly 50% of women in investors' team. And this is a bit lower for the C-suites, the board of director, or investment committees. Then we asked fund managers about their motivation to adopt GLI strategies. And the answer we got the more often is simply that it's the right thing to do to address gender inequalities. It was also often in line with their sustainability strategy. And I think very interestingly, many managers answered that SDG 5 is a catalyst for all other SDGs. And finally, we collected several impact metrics in terms of country, investee, and client outreach. So looking at the country outreach, we calculated the gross national income, the average gross national income per capita across all funds. And we see that it stands at about half of the world average in 2021. So this demonstrates the ability of PIFE to channel capital to households in countries with income levels below the average. In terms of investee outreach, I think this is interesting to see how PIFE are contributing to job creation or support into emerging markets and frontier markets. So our median observation is 15,000 employees. And out of these, 37% are women. And I think this is interesting to see that it's a little bit lower than the figures we saw at the investment manager level just before. And finally, in terms of end clients outreach, our median observation is 130 end clients, of which more than 60% are rural. Of which 60% are rural end clients and women. So again, this demonstrates the possibility to reach out to underserved communities through PIFE. And this year, we also started to collect impact metrics on the outreach to youth and clients, which stands at 11%. But we saw that this metric is still not very widely tracked or reported. So as Ram mentioned, we're going to publish the report in October. So if you'd like to get the report, if we would like to send you the report, if you'd like to know more, you can just scan the QR code or follow the link, and we will be in touch. We will show this slide at the end again, so don't worry. And so now, moving on to our panel discussion, I would like to welcome our 3 panelists for this, and it will be moderated by JP Delman, founder and CEO at ILA and Partners. So the floor is yours.
Hello, everyone. How are you? Good? Did you enjoy that? Can you hear me okay? Yeah? Yeah, I think I cannot hear very much, so how do you enjoy that? Very good. Do you have any questions already? Any shows of hands just on the report so far? No? Okay, that's not so good. But what we're going to do now, obviously we have this incredible panel. I wanted to thank, first of all, I'm going to thank again Ram, Anne, Robert, Hamilton as well, who did a lot of work to make all of this happen. And of course, Tamio and the sponsors. And we're going to go straight into it. We have, I think Ram mentioned, a few questions that we're going to cover with the panelists. And then ideally, we're going to have some time to do some Q&A. But since you don't have any questions, I guess that we're not going to do any Q&A. Yeah. But anyway, just keep it going. If you really want to interrupt us at some point, please make sure that you do that. There's no problem if it's a short question. If not, save it for the end, and then we will cover it. So without further ado, how are you? Good? welcome and thank you for being here. The first question, I'm just going to jump straight into it, is about any surprises on the report. Who wants to go first? Yeah.
No major surprise, I want to say, even if there was a very large download of information. Thank you. I would say that I was not surprised to see that microfinance still represents the bulk of impact investment, and it's declining. The reason being that there's still a very large population that is financially excluded, and we know that financial exclusion is a barrier to development, whether it is societal progression, access to education, or ability to smooth sometimes revenues that are not recurring or not stable, but also for micro and small enterprises, the inability when you are informal, which is the case of most micro enterprises, when you are informal, despite your contribution to the GDP and the workforce, not accessing financial services generally prevents you from growing your small business, prevents you from accessing new markets, and there's an entire inefficient value chain around that issue. So not surprised. But also now, and of course I'm preaching for what I'm doing, now that technology has entered every household through the mobile phone, there's a new era for financial inclusion with fintech appearing in the stats that Tammy was shown. Sadly, agriculture, which Nabil will talk about, is still very difficult, requires very hands-on investing, and at responsibility or practice around agriculture is also smaller. We're coming from microfinance, we've entered agriculture, and we find it still very difficult, and it takes time to bear the fruits of your investment. And on climate, what I was not surprised about is to see the large amount of public funding that supports this agenda, because indeed, this is what we need to do to survive. I'll pass on the mic maybe to my colleagues.
Yes, absolutely. Thanks, Sarah. The report resonates quite a lot what we see in the market or what we experience when we talk as well to investors and even launch new initiatives there. One interesting point I saw is as well that, let's say, smaller topics currently, apart from microfinance, like water and communities and agriculture, are picking up. But still in the topic of water, which is going to be crucial over the next years, we see currently out of the report, the focus is still on that. And I think patient capital is needed, and that's where we are contributing even in the future. I think patient capital is going to be a big topic, even in this kind of more nichier, let's say, strategies or sectors. In terms of what was not surprising is absolutely the focus on gender or gender smart investing, the next step. I think that's going to be the big topic we see in all, let's say, investment classes all over impact investing. For me, what was a little bit surprising is that 2/3 of the, let's say, investor money is from the private sector, private institutional sector. That's not really reflecting the reality we see when it comes to fundraising, but maybe, yeah. Good.
Yes, hello. Well, I think the report gave us a great insight and granularity into the space, so to speak, and there are a few takeaways that came out for us is the multi-strat type sector or other type sector, whereby we are asking ourselves, is it by design, by the managers to offer some kind of multi-strat in the private asset environment for impact, or is it because it still remains very difficult to channel capital impactfully, whether through debt or equity in emerging market, because there are a lot of hurdles along the way, which are not about people wanting to do it, but how do you do it, and how you get supported noticeably by the infrastructure and the service providers. So this is the question. I mean, we want to drill down more on this to try to understand where that multi-sector comes from. Is it by design or, let's say, the result of market inefficiencies? And then the investor flow. I mean, that was mind-blowing for us to have that drill down in terms of who's providing the money in what type of sectors. I think this brings a lot of clarity to the asset class and to impact funds, because we never had access to that kind of information. So for us, it's really it's really very important, because sometimes there is also there, as you mentioned, a dichotomy between what institutional investors or private investors or retail investors do practice, do preach, and what they practice effectively. So I think this is an extremely important milestone for us in getting that type of granularity. And finally, I think here also, again, the issue of private assets between debt and equity, how does that flow around? And what's very important for us is also to notice that if you have private assets going to impact funds, I think emerging market was something like 170 billion odd out of 259. And that means that basically most of the impact-minded capital goes to emerging market. So what is it that you do in mature economies? Turning the, what is it that you do in terms of impact? Is it regenerative activities, regenerative economies? What do you do? I think that also needs to be answered, because there was I don't want to overstretch it, but there was the usual dilemma: can you only do impact in emerging markets, or can you do impact in mature economies as well? And now these two collides in the minds of investors. We as manager can do, but what do investors have in their mind? That's the other key takeaway we have.
Perfect. And so that's very useful, and we're going to come back, I think, to a couple of those points. But anything that you disagree with, just to put a bit of contentious part to it? No? Nothing you said? Well, actually, I think you mentioned in some cases not what you appreciated in terms of maybe the type of investors, and maybe it's not the clarity point in terms of, developed markets, and maybe we'll mention about that. But okay. So in that case, let's quickly move on. I did pick up there that there was growth, kind of post-pandemic. And perhaps, we can talk about the market size and what your experience has been in terms of fundraising. I think let's start from there. Maybe you want to, Mark, do you want to go first?
Yeah, okay, no problem. Well, what we saw, and without cutting the grass under my colleagues, I think we saw a lot of dry powder. That is willingness to invest from the investor side. So a lot of money that needs to be deployed in impact, and sometimes it's counterproductive, because as there is a lot of money that people want to deploy into impact, then they maybe not deploy it the best way, or they ask managers that are round to fit in a square, or that are square fit in a round, which is a bit of a transvestite of what should be done. So that was the take that we have, that demand is very strong. Nevertheless, you need to channel capital down in the most proficient and institutional way. So that was what we saw in terms of fundraising. Yeah.
Yes, I think absolutely. The demand for impact investing is there. We see an increased demand, might it be from institutional investors, from private investors, or ultra-high net worth families. But having said that as well, faith-based institutions are on the next edge to invest a kind of mission-based aligned in terms of impact investing. During the pandemic, or over this kind of period, it came to a kind of certain halt. Obviously, investors wanted to see first, because it was for the first time hitting the real economy during the pandemic. So they really wanted to see what's happening on the ground. How resilient are emerging markets when it comes to pandemic or external shocks? So, but on the other hand, even investing in these kind of companies, there was no demand, let's say, for microfinance institution on their side. So it was difficult to deploy during this time of period. So cash levels in different funds were quite high. I think this was a challenge, but this situation now has completely changed. I think now we're going to see much more demand for investees on the ground, because economic activities is picking up, has proven very resilient. Investors know that if they engage in emerging market, the perceived risk is not as high as we might think. So I think that's a little bit what we have seen over the last years, but the engagement is very strong from potential investors. As you mentioned before, you see a demand a little bit liquid solution, illiquid solutions, but they want to engage, and I think that's a very positive sign.
maybe just to add one specific comment on fintech, on the fintech world and the post-COVID, during COVID and post-COVID environment. COVID has accelerated the adoption of technology in general globally, and that's also true, obviously, in emerging markets. And therefore, the fintech companies that were starting their journey or were already operating in countries have greatly benefited from that accelerated adoption, whether they were delivering financial services to individuals who have started to buy through deliveries for their groceries and all sorts of items, but also has accelerated in general the mobile commerce or e-commerce. And therefore, what that has created for investors is a market euphoria where all of a sudden the business plans that were invested were reached a lot ahead of time. And therefore, those companies were in need to raise more funds. And so the fintech funds deployed their money also faster and went back to the market to raise their follow-on fund. And investors at that time had great appetite because they did see indeed this acceleration of technology, which was pushed also by governments in order to deliver subsidies, also because governments just have an interest to track transactions so they can levy taxes. So all of that was created craziness in the fintech space in general, not only in emerging markets. Valuation went through the roofs and everybody was happy essentially. And then since the interest rates have started to increase, and so a lot of money that was chasing yields has decided to stay home or is more hesitant to invest abroad, compound with the Ukrainian war, now we're seeing that LPs are generally having a much harder time making decisions and investing. And so there's been a lot of dry powder, a lot of money raised, which is transforming into dry powder today because the macro conditions are a lot more difficult. And therefore, both the LPs and the fund managers need to be a lot more discerning in the way they deploy their money.
Excellent. I'm going to steal the other mic if you don't mind as well. Christian, can I have just one more? So that you have your own. Oh, sorry. I want to leave this one. So one thing that comes to my mind is that I've seen it with some of the funds we work with, is that those that had investment, kind of, let's say, not in fintech or high growth, and those that benefited, inverted commas, through the pandemic, is that they actually had some difficulties, right? Because they had to deploy a lot of capital just to keep those companies afloat, which, really hit, kind of the immediate kind of returns in a way. And we may mention about that. But one thing that stuck in my head when we did the pre-call, Nabil, Mark, is you mentioned about, some of the investors kind of coming to want to do impact, to want to do investing, but not really knowing what they wanted. So they wanted to do it. I like that phrase. I don't know what I want, but I want it now. And so I was a bit curious if you could share, some more about that. Combine, if you don't mind. I don't like double questions, but the fact that we do find a lot of investors, especially when we talk sometimes in LATAM with some of the companies that are fundraising, the impact companies, where so-called impact funds. Again, I use that phrase lightly, let's say, are still pretty much chasing returns, although they promote themselves as chasing impact. So
yeah, I mean it's effectively what we saw is that there was this eagerness to invest for sure. So capital is there, and then we are in a sector where we were talking about food and agriculture, and 99% of our investments are around private debt, where you are directly providing capital to corporates. So to do that, you need time. To do that, you need research, you need due diligence, you need AML, KYC, KYT. If you top that with emerging market, that makes it a proposition that does take time to develop, to deploy, and so forth. So faced with that kind of in our case, hurdles to deploying capital, people have tended to do, let's do something else, like do an hybrid of debt and equity, or do convertibles, or do provide debts on different spectrums of the duration, short-term, mid-term, long-term, do convertibles, and so forth. I mean, as educated GPs, obviously we do have the processes, we know what we do, we have been in the market for quite some times, but that doesn't mean that we're going to become whatever people want. So again, there are out there many different recipes, many different shades of grays, if I can say so, and it's our job as GPs or investment managers to, as best as possible, without being cocky, try to take the hand of the investors and educate them through the pathway of impact investing. And in that sense, not only doing the flabbergasting of putting impact on your forefront, but really taking the hand of the investor, bringing him through the journey of what does it mean for you impact, because I'm sure as many people in the room, we have different definition of impact. So in that sense, make sure that you have alignment of interest and expectations, not to create mis-expectations. So that was for us very, 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 I would say, marking, specifically after COVID.
Excellent. And maybe that's a really nice segue to talk about more on what you are doing, and what your firms are doing. I'm sure for those that do not know you already, and you're quite well-known firms in a way, but it never hurts, and then maybe share some of the focuses that you have right now. Perhaps Christian, you want to go next?
Yes, thank you. So Incofin is an impact asset management company based in Belgium, existing for over 20 years. So, as you mentioned, doing investments, you need to be on the ground. So more than half of staff is really local in terms of deal sourcing, but as well preparing the field. So Incofin is active, let's say, in three main sectors. One we heard about already, financial inclusion, which was really the start. But it goes further, agriculture, so the agricultural value chain. Currently, the majority is, let's say, financing smallholder cooperatives and providing them a kind of bridge capital because they're export-oriented. So whenever they've sold the coffee, then they're going to pay back the debt. So it's more, let's say, debt-focused structure there. But in terms of innovation, of what investors are requiring now is going a step further. And even in the agricultural value chain or agricultural sector, we can achieve that. But it needs a lot of investigation in different markets. So what we are now doing in order to promote nutritious food, which is going to be important, especially in the emerging economies. So we going to provide, let's say, that capital to companies in Africa, which are catering the local demand. So rather to export, so that's another step, really focusing on the local demand. I think that's a kind of evolution we are bringing to these kind of markets. On the other hand, one very important topic, Incofin was now venturing over the last, let's say, 2.5 years. And this is just to show how much time it takes in order to provide clarity or, let's say, proof that the sector is financially valid. It's a safe drinking water sector and providing long-term capital. I think still these days you're talking about 2 billion people don't have access to clean and safe drinking water. And we're not just talking about, let's say, the rural areas. It's as well valid in the let's say, more urban areas, in the cities, which is even more important there. So together with the different partners now, and then it comes more to the blended type of structure, equity providers. So we are preparing the field, so going a step further, venturing into new topics in impact investing. And in terms of private equity, private debt, we do both. And sometimes we see as well, we're going to focus on specific countries, or you can even say a kind of continent, how someone, India has been called. So it's really entering there, providing longer-term capital with private equity in the sector of fintech, financing, or agriculture.
Cool. I also work at Responsibility. I realize that you might not know that, but I am in the private equity fintech team at Responsibility. So very quickly, the headline numbers for Responsibility. Created 19 years ago, managing $3.6 billion under management, 3 verticals, 2, the biggest of which representing about 70% of our assets under financial inclusion and fintech, agriculture, and climate finance. Our climate finance practice has grown very quickly and now is just short of $1 billion. We also do debt and equity. We have dedicated funds and we have mixed funds. The fintech fund into which I work is pure private equity that was started as a Swiss company, so an open-ended evergreen patient capital. Generally, we have touched water, but we've done a bond, a water access and access to sanitation bond with the blended structure also. But more specifically on fintech, what we do is that we started as a traditional microfinance impact investor 19 years ago, and so we deployed money across all emerging markets through financial intermediaries that were at the time microfinance institutions and SME banks to cater to the 1.4 billion, at the time I think it was 2 billion individuals lacking access to capital and what is today still a $5 trillion gap for MSME finance. But we've also followed the evolution of those emerging markets where we operate. And when the mobile phone appeared and with young population adopting quickly this new tool, it really became obvious that the delivery of financial services, and especially the last mile delivery to the low income in rural areas where it's very expensive with a brick and mortar structure to deliver financial services, it became obvious that the mobile phone was the tool to deliver those financial services in a more economical manner with unit economics that are better, but also at scale. You know, you don't need an army of loan officers running around in the countryside on their motorcycles. You can really reach individuals at the time they need with a level of customization for financial services, which is also much greater than what traditional financial institutions have been able to offer. And you can embed, and we've seen that term on the Tamir report appear, you can offer embedded finance at the time it's needed, whether it is, and generally that's the time of purchase, and so fintech starts with payment, and as you create a digital trail, and this is important, you can start to see transactions that are being performed as payments, and you can use this data all of a sudden to underwrite, which means to evaluate the creditworthiness of individuals and companies that were informal, unknown, unbanked, deemed unbanked by a lot of traditional financial institutions. All of a sudden, they have a digital footprint. You can use it. You can put some machine learning, artificial intelligence onto that to segregate individuals and MSMEs and bank those customers who were informal. And by bringing them into the formal sector, of course, you accelerate their growth. They can access, you can start with one digital payment and then digital lending, and then you can add on the suite of financial services, savings, InsurTech, obviously, you know, providing health insurance is also creates resistance and resilience for this low-income population. So that's why the evolution from traditional financial services intermediaries into investing with a fintech approach.
Excellent, thank you. Yes, good point about responsibility, because I was going to mention that. And anything else that you can add and share about Inox Capital before we move to the next question?
Yeah, quite briefly, we are providing capital for growth to corporate which are active in the agri and food sector in emerging market in a sustainable manner, and we provide impactful capital solution. We've been doing that since now 16 years. Yeah, that's it.
Excellent. And I'll save a little bit about me for later if we have time, so that we keep focusing on this, which is the next one that I had in my mind was about deals. You know, deals and valuations. You know, at the same time you see the dry powder. You know, but what is happening on the other side? You know, on the pipeline. And how you find it in terms of finding the deals, and then once you find them, are you able to get them? I'm happy to Christian, you go first, Sarah. You go first, please.
Okay, I'll be brief this time. As I said earlier, the fintech sector has exploded during the pandemic and thereafter. Lots of money. There was a lot of competition on deals. Valuations exploded, and we're oftentimes out of our means. You know, we're still a small fund, so we were in competition with Silicon Valley money, which did due diligence in a day or sometimes over a conversation, which as an impact investor we can't do because we are answerable to our investors and they really want to see the baseline for impact that on which we are investing. So we couldn't do that. We've lost some deal indeed. But we've been on the ground for sufficient time with teams on the ground who have their network to continue have a pipeline. And I would say now it's becoming easier because a lot of this high-flying money has returned home or is not as aggressive as before. So I would say the sector has returned to some form of normalcy. Valuations have returned to some form of normalcy. And the time where acquisition of new clients was just done with your next round of equity that you were going to raise tomorrow is not happening any longer. And so now investors are, and companies also are aware of the fact that they need to look at their cash flow more closely and they need to break even, not in 10 years with the promise to conquer the world, but possibly next year, even if the growth needs to be somehow, to some extent, sacrificed.
Anything else you would like to add?
I think on the debt side, obviously, we have seen as well competition in terms of yields. The overall yield, especially in financial inclusion sector, has been coming down over the last 10 years. But as we have seen on the entire interest rates levels, I think they went along with this side. On private equity, yes, let's say, for example, on the water sector, do we face a lot of competition there? No, because it's a new sector. We're venturing into this, so it's a completely different story. And I think in terms of size, differs as well. Are you competing with the big guys? Is the fund smaller? Are you more?
Nobody wants to get into water.
Exactly. So I think understanding as well, and that's crucial for the potential investees, the value proposition Incofin can deliver, being on the ground, helping them, because what we do is growth capital, so it's less venture, so it's maybe Series A, Series B, but providing growth. And I think that can leverage our expertise, especially in India. You see, we have 2 offices on the ground, so they understand. I think that's why being local is so crucial. Yeah.
Yeah, rapidly. I mean, we provide mostly capital to corporates, which are, we call them corporates, although they are SMEs, because they are real corporates, although they are SMEs. And I would say small, mid-market companies. The space is specific enough not to have the big guys come around them. And therefore, the type of liquidity we're able to provide them, although is always competitive in terms of cost, in terms of effectiveness, in terms of technical assistance that we provide embedded, and we can engage them on a closer function. And in that sense, you know, it's farmers speaking to farmers, so it's always better than a banker speaking to a farmer. So in that sense, I think it's been quite good for us, and the opportunities are there. Capital is still very tight and very expensive in any case, and not about to go cheaper, considering the base lending rate increase. So yes, competition, but competition, we're not afraid.
Okay, good. Competition is good. And yeah, I may come back if we have more time on some of the specifics about how we're deploying this, but I don't want to run out of time before just touching on the gender lens point. And again, let me repeat, and I'll repeat again afterwards. I think it's 4 p.m. RAM is also hosting another specific gender lens focus session. And that one goes on, I think, for 2 hours or so. So if you're interested, please come and join us. And maybe on this one, let's start with the basics. You know, what is gender lens investing? Who knows what gender lens investing is? Anyone? Just to make you move a little bit. 2 people, 3 people, 4 people. Okay. Out of we have about. If you cannot see the cameras, we have about 1,000 people in the room today. So,
Favorite panel of the morning.
yeah. So, Sarah, would you like to go first, if you don't mind?
Sure. So I'm going to go with the official definition from the GIIN, which is the Global Impact Investment Network. So gender lens investment is a strategy or an approach to investing that considers gender-based factors across the investment process to advance gender equality. So what it means is that as you evaluate a company in your due diligence, you take into account not only financial indicators, but also gender indicators. This is important because it has benefits. It has benefits now that have been proven for a long time across numerous studies. And come to me if you want to know what those studies are. And it is important because, as I was saying, the gender lens investment has significant benefit because it fosters innovation, resilience, and offers better profitability. So let me give you just a few numbers to keep in mind, in my opinion. So I'm going to read them out. The gender diverse teams financially outperform their non-diverse counterparts by 25%. The above average gender diverse management teams report an innovation revenue 19 percentage points higher than those with below average diversity. And companies on the MSCI World Index with strong female leadership generate a return on equity of about 10.1% compared to those that do not have a strong female leadership and to 7.4%. So what those numbers show, and we can debate, the number after the commas, and the decimal can be always discussed, and there are cases that are abnormal. But if we're taking the average, what it demonstrates is that gender lens investment is proven to lead to positive, desirable income, both for society and for business. And one point that was shown in the Tameo report that I could not disagree with, but infuriates me, is that a lot of companies enter the gender lens investment space with the objective to channel more money to women or to companies that are offering services and products to women and girls, but do not recognize that it is also needed to have a female, to account for women in the leadership, that equality starts at home. And of course, that responsibility, we pay a great attention to that to ensure that promotions, hiring is also including women in a fair manner, and we have gender targets. But it starts at home, and generally, at least in the investment space, you get referrals of deals through your networks, whether they are formal networks or informal networks. And some of those networks are gendered. So if you don't have women in your team, it's going to be more difficult to identify female-led or female-owned companies.
Thank you so much for that. I hope that. Do you know now what gender lens investing means? Raise your hand. Okay, we have about 990 people now. Okay, we have some questions. So hold your horses. I saw about 10 hands coming up. Just give us 5 more minutes. Yeah, we're just about to finish. But I like that. So it generated some real interest. Let's go to the point, right? So how are you implementing it? So how is it possible to do it? How do you do it, in 30 seconds?
I'll let my colleagues speak a bit.
Okay, I'll kickstart. 30 seconds. Well, it's simple. All our funds work around the 4 same impact teams, and women empowerment is one of them. So it's easy for us in that sense. But it's not that easy when you talk about emerging markets and agriculture. It's not easy to find companies, corporates, which are women-led, unless you go into very specific activities which are side to the value chain. So it takes a lot of effort, and that's where our first technical assistance programs are coming for, whereby we really want to channel capital to corporates which are open to the idea of change, which is time-consuming, but that's the beauty of it, because once as you said, the organization is amicable and aware that it is a great enhancer, not only in the profitability, but in terms of risk management, because you know better your environment, your nexus, your supply, your demand along that route, then you're able to gather them working in synergy with the object, and that's where you get the change being driven. Yeah.
Yeah, so the gender smart investing is embedded in the investment process at Incofin, definitely. So right from the start, we do a kind of gender assessment, focusing as well on the 2X initiatives. So, but that's more a starting point. 2X shows, okay, you're going to have some numbers. Is the company led by a woman? So let's say, what about the management? How many women are in management and on the employee levels, but as well on the services provided to specifically women in these areas. But having said that, collecting these, that's just a starting point, because you might count how many women have access to financial services, yes, but we all realize that there is a cultural bias when it comes to, and I think that's going to be the next step, and that's what we need to implement as well. So it's not all about gender equality, where women have access to financial, let's say, services. It's about gender equity. You see, increase the starting level, give every single individual the same starting point to access these kind of financing. I think that's a long way ahead. We're engaging heavily. We want to promote as well kind of industry standards. That's where Incofin has always been at the forefront, coming up with practical solutions as well. But I think, cultural biases and gender equity, that's going to be very important in the future.
I'd like to build on what Christian had just said. And of course, financial services, especially when we're talking about microfinance and fintech, were originally targeting women. So, of course, a vast majority of our financial inclusion portfolio goes to women, whether it is on our debt product or our equity product. However, we have also started to include in the baseline that Christian was mentioning, when we are doing the due diligence and creating this baseline, we're working with our portfolio companies now to go beyond the delivery of those financial services to women who we know have been disproportionately affected by the pandemic. And we are working with them through dedicated technical assistance or through our participation at the governance, the board of directors, to implement anti-harassment policies, maternal leave policies. In certain instances, also, we've seen that it's great to hire and retain and promote women within the companies, but sometimes coming to work is also not safe. So you need to think through transportation for your female employees. So we're trying, from the inside of the companies, we're trying to change this bias that Christian was mentioning. It's not only outside, it's also inside. And how do you promote an equitable workforce, not only through your business model, but also through your practices internally as a company?
Excellent. So I hear quite a few things there. Obviously, in terms of by sector, it differs by points like the cultural part, points in terms of the complexity. Is it really about the SMEs? Is it about the funds? Is it about the end user? It always shocked me when I learned that, when talking about financial inclusion, that in Mexico only 10% of women have access to any financial product whatsoever, and then they pay 15%. Everyone pays 15% cost on their income, because they work on a cash economy. So I have a couple more questions, but just mindful of time, I want to give you the chance to ask questions before we finish. So who's going to be first? I'm going to pick a lady. So very handsome man on the right is going to have to wait. Let's pick here, if that's okay.
Hello.
Hi. If you can say your name, if you don't mind, and if you have a specific question for somebody, we can hear you. It works.
You can.
Yeah,
Okay.
Yeah.
Hi, I'm Michelle Choi. So thank you very much for the presentation. I think Sarah might have already answered this in the last question, but I guess what I've seen through my research is that most of the women are still the unbanked population. And like you said, microfinancing is such a big part of kind of impact investing. What are still the barriers that you see for women to get credit access? And how does Gender Lens see kind of the impact investing world in creating initiatives through fintech for the women to kind of maybe get access to mobile accounts or education in the fintech space? Because it seems that, it's been so long now that kind of the sub-Saharan Africa and developing economies have kind of leapfrogged some of the advanced economies and how they kind of promote financial inclusion. I'm wondering if that's something that you see that maybe possibly fintech can help leapfrog women into becoming more financially inclusive.
So there is progress, even if, as you said, there's still many women, and I think the latest numbers I've seen is about 750 million women are still excluded from the financial system. First, things are very basic. The hurdles, you've asked for the hurdles. Some are very basic. Having an ID card under your name, having the ability to go outside the house, so having your husband or father or brother let you walk outside of the house so that you can go to a meeting, for instance, if you want to access microfinance. So this is for the traditional model. Having land titles. There's an inheritance problem in most emerging markets. There's a lot of emerging markets where there is no land title for anyone, but when there is, in the cases where land titles exist, they are in the name of males. So you have no collateral as a female. You have no stable income. You are in the informal economy. You have no collateral to offer. So your access to financial services is very difficult. Then there's usually lack of, again, as a girl grows, the dropouts are generally girls. They get married early, and there's no childcare. So very quickly, as you get married, and of course that's not the case of all women. There are very well-educated women, and in the banking industry in India, half of the leadership is female. But in most lower income strata of the population, you get married early, you have children quickly, there's no childcare, you stay at home, you look after your children. And when you are educated and you go to work, you also need to rely on your local support system, whether they are your parents, your in-laws, you have enough of a salary to have a nanny, but childcare is a real problem. And then there's the care economy. Who takes care of the aging parents? That's the women. So I think there are a lot of hurdles. Where fintech can help is that indeed it can go into the homes rather than asking women to get out of the home. And it's not only about getting permission to go out of the home, it's also the time it takes on your daily schedule while you already have to fetch water, look after your kids, prepare the food for your husband, your in-laws, and the rest of it. So I think the time, the efficiency to access financial services is important. The last point I want to mention is financial literacy, because of course you're not going to buy an insurance policy, especially in the current times where the available income reduces with inflation in emerging markets starting to pick up. You're not going to buy insurance if you're not educated about what it is and why it's needed and what risk it can cover for you. So I would say that financial literacy, not that it is fintech, but technology can support the dissemination of financial literacy.
I can add something on the specifics on the solutions, if that's okay. So let me just quickly actually do the introduction to what we do so that there's a bit of context. So Aile and Partners, we really are on a mission to enable the transition of capital, right? To move capital into sustainable and impact investing. We work mainly with kind of large investment managers and large institutional investors. But at the same time, we do have a specific focus with fintech, with financial inclusion, education personally in terms of SDGs is one that is at the top of my list, and for that reason we do selective work with companies, right? And we're working with a company in Paraguay as a case, it's a fintech company, and that's where you realize that the solution comes. I am a capitalist, private markets supporter and fund. And that's where you see that entrepreneurs come with innovation to actually find the solutions. So this company is called, if you don't mind, I'll actually share because I think it's a great case. It's called eClub. They're starting in Paraguay because it's a good kind of test. 7 million people. However, more than half of the population is under 35. So they're trying to use everything that they know as from the financial markets, the founders, which again is a challenge with the founders not being maybe at the top 4, out of 5 people at the founders, only 1 is a woman. But they are finding a way so that people can access something immediately, even with all these challenges that you mentioned about the IDs, obviously the regulation. You have to be very, very savvy about so many things to be able to deliver on this. And then there is other points, which is all those that you see today. Let's say again, I have a specific soft heart with Latin because I'm Anglo-Argentine, but is that you realize that those that are still entering the market, which by the way is top 2 with Africa in financial services returns, are still focusing on the served kind of customers, not the underserved customers. So all of these, great marketing that you see out there, they still not hitting the problem. So I think that there is a still. Always, I think when you see people doing the investment, or if you as an investor are doing and you're allocating your money, you have to look into this, to actually see under the bonnet, to see what actually they're doing, who they're targeting. And I think you hit on the head of the nail there with the educational part, because it's not just a matter of giving them access, to a bank card and then financial products, because if they don't know how to behave, on how to manage, their finances, it becomes a real problem again. Sorry, I can see you eager to say something there, Christian. Go on.
No, just on the educational side, absolutely, it's crucial, but we need to introduce as well education, let's say on the investee level, train the investment office or the credit officers there directly to understand what's the need of the woman there, provide, let's say, services which cater to their needs, especially, let's say, in the agricultural sector. We finance an investee company. The penetration was quite low in terms of credits to women. But then they realized going on the field, what's the issue? And you mentioned it, childcare. They cannot leave. They need to be there. So it's a kind of more practical approach. So they changed it. They came on a journey with us in order to improve it, provided a service going on the ground, maybe dedicated time, so that they can leave. They don't need to have a journey for 3-4 hours and then getting back. So I think education is key, but not just, let's say, on the micro entrepreneur, but as well on the investee level. It's a journey there too.
We're going to jump quickly to maybe the last question, if that's okay, and then we're going to do a quick wrap.
Thank you very much. Can you give us some color on the performance of emerging market impact funds in absolute terms and relative to non-impact funds in the region?
Thank you.
Thanks.
I'll kickstart. On our side, I mean, our own performance was superior to what you saw there on the average, by far, on the unleveraged, because we're unleveraged. And we're at par, if not better, than the non-impact fund active in the same value chain and providing capital as well. And we believe that's because specifically of impact. We believe that impact is not an overlay. If embedded in your sourcing, I mean, research, sourcing, due diligence, and post-investment risk management, it's a quest for efficiencies. And if you get companies that can adopt these practices or are willing to make the effort to adopt these practices, then you're funding investees or providing capital to investees which are themselves looking for efficiencies. So technically, they know better. So you do better. As simple as that.
So as an example right now, having a look at the market, financial institution or microfinance, financial inclusion, year to date, on average, let's say plus 2 to 3% in US dollars. Compare it to the JP Morgan Emerging Market Bond Index, minus 17, 80%, 20%. So that's what we are, when we talk to institutional investors, providing as well. It's a good diversification into your portfolio because volatility is by far lower. Obviously, it's private market, it's not daily listed, there is a difference. But still, to answer your questions directly, yes, have a look at year-to-date returns. Can you expect, let's say, financial inclusion every return plus 7, 8%? No. It's going to be on average plus 4%. But the beauty of it, since inception, more than 20 years, financial institutions, or financial inclusion, microfinance, however you want to call it, has never experienced a negative year. So I think that's a strong argument in terms of just the debt side. On the equity side, we see quite similar returns on the growth space or in the growth space, depending a little bit what your strategy is.
Yeah, I don't have much to add. Microfinance, Christian has already covered the returns of our fund or what he mentioned. So no negative year, generally slightly better than what the market does. On private equity, I would say it's very much depends on your investment strategy. It's difficult to speak with a broad brush because it depends at the stage at which you invest. Are you VC? Are you $20 million ticket at the Series B? Or are you growth? Do you bring companies to IPOs? So we have in our portfolio, we have very nice successes and we have failures. We have invested in the largest payment platform in Egypt that went to IPO, and we've already done partial exits. We've already recovered our money. The valuation touched almost $2 billion, and now it's much lower because it's suffering the fintech deflation. We have investing in other tech companies where regulation has changed, and the way the company, there was an invoice platform, the way the company was sourcing money from a certain category of investors was not possible post this change of regulation. So I think it's difficult to give you a broad idea. I know that there is the Cambridge Associate research, but I did not see the recent edition, so I wouldn't want to venture out quoting numbers, but I know this is a source of information that could be useful.
And just one last comment I'll add is that we are working with the Carbon Management Solutions growth fund, which is actually having an immense impact in terms of climate, and we saw now how they split it on the sectors, I think, which I had a point about. There's not much water and not much lens as a one line, but they are doing mid-20s, low 30s, which is, and it isn't, to me, is complete impact in some respects, maybe not to the specific technicality of the definition. However, whenever you pitch as an impact, people don't want to look at it as such, and they just want to look at the returns, which is fascinating. But then the other part, the other side of the coin that I thought about is that we talk about performance and returns, etc., but is that social effect and impact that it has on the other side, right? That, again, we are not talking about, I think they say a panel yesterday talking about the S on ESG, and all of this that is generating, and think that, again, maybe is one of my questions around the report and how much more information we need to understand what impact is creating. Okay, that's it. We're gonna ask you one last statement, if you don't mind. Again, this is in 30 seconds. So the main message you would like the audience to take away, and perhaps or a call to action. Shall we go from that side to this side? Nabil, Mark.
Yeah. One simple thing: impact is not philanthropy, but it's as good.
I think there are more initiatives, more solutions for investors, let's say through blended finance, catering the different needs, from philanthropic money to pure finance first capital. So everything is possible, and with blended finance you can de-risk structure. So I think impact is embedded in, or let's say impact investing is providing huge potential there too.
I'd say impact is a continuum. So you have, depending on the investor you are, you can position yourself on the risk-return continuum as you wish and integrate the degree of impact that you want. So there should be products available for multi-type of investors. I would also like to say that this is a growing movement, and it will become mainstream eventually. We will not talk about impact investment.
I just have one last thing.
Yes.
It's a call for help. We're in Switzerland. You say 15% of managers. You do emerging market. No Swiss banks will bank you. For the records.
Okay.
So you do impact in Norway, and they'll bank you.
Excellent. And all I would say, and I'm actually going to finish with this, is just get involved. It's really good that you're all here today. And remember, again, Gender Lens, we had the 4 p.m. Session with Ram and the team. And you as well. Apologies. And we have the QR code that I think was there before. I'm not sure if you're going to put it again. If you want to be one of the first to get an alert when the report is published. And then do remember that this is actually funded by great sponsors. You saw that as well at the beginning. So if either you or somebody you know is interested to support the great work that Tamio is doing, it's a great story. And maybe it's a plug on this one. We did I have a podcast called Impact Leaders, and we did a great interview with Ram and Safia about it. So where you can actually learn about the story of Tamio, which I think is one to follow. And Safia is there. Raise your hand. So with that said, last is we have I think it's a 15-minute break, 13 minutes break. And then the next session starts at 11. So big thank you to Tamio, to our panelists, to our sponsors, and to all of you. Thank you, and have a blessed day.